This is Market Minute, the weekly brief. Before we start, nothing here is financial advice. This is a recap to give you context, not a recommendation to buy or sell anything. For 2 years, one instinct made investors money. Whenever big tech spent more on artificial intelligence, you bought the stock. This week, that instinct broke. The spending was still there, growing even. What changed was how the market chose to read it. 6 threads to pull on this week. A tape that turned. A reckoning with what artificial intelligence actually costs. A crude oil shock. A relentless wave of deal-making. And a rulebook shifting under everyone's feet. They are more connected than they look. Add a crude oil shock that pushed past a threshold Wall Street had been dreading, and you get a week that ended lower, more nervous, and asking a question it had not asked in a long time. What if the AI boom costs more than it pays back? Here is the week. The week did not fall in a straight line. It lurched. Monday opened soft. Then Tuesday roared back as chip stocks found their footing, and for a moment the old script held. By Thursday's close, that optimism was gone. What turned the tape was not one crash. It was a slow reweighing of the year's biggest bet. Day after day, investors looked at big tech spending plans and liked them a little less than they had the morning before. Consider the whiplash. On Tuesday, a rebound in chip stocks helped lift the major indexes, and it looked like buyers were stepping back in. By Wednesday, that rebound had lost steam, and by Thursday, the selling was broad and deliberate. This was not panic. It was a market slowly and quite coldly changing its mind. Measured from the prior Friday through Thursday's close, and remember each morning's paper reports the session before, so the week's math runs Monday to Thursday, the NASDAQ gave back about 1.5%, and the Dow shed a little under 1%. Modest on paper. It did not feel modest. Underneath, the bond market made the whole thing heavier. The yield on the 10-year Treasury, the number that quietly sets the price of nearly everything, climbed to an 18-month high above 4.7%. When borrowing gets more expensive, the most expensive growth stories get repriced first. So here is the frame for the week. A market that spent 2 years rewarding ambition suddenly wanted to see the receipts. Here is the shift that defined the week. Wall Street woke up to a new reality about the companies at the center of the AI trade. The biggest names in tech are no longer the cash printing machines investors had come to treat as a law of nature. Take Alphabet. It grew revenue 24% from a year earlier, the kind of number that used to end the argument. This time, investors skipped past it and stared at one line instead. Free cash flow came in at negative $5.9 billion, the first negative reading since Google went public. The company now expects to spend as much as $205 billion building AI infrastructure this year alone, and the appetite is still growing. OpenAI raised its projected spending on computing power to around $750 billion through the end of the decade, up from a plan of roughly $600 billion just months earlier. AMD signed a deal to ship Anthropic tens of billions of dollars of AI servers. The building is not slowing. The patience for it is. And the damage did not stop at one company. As Alphabet slid, the selling spread across the whole complex. Meta fell more than 3%, Oracle more than 4%, as investors extended the same worry to every firm racing to build out data centers. For the first time in this cycle, the capital spending arms race was being read not as strength, but as risk. The market did the math out loud. The group known as the Magnificent Seven shed close to $890 billion in value on Thursday alone, and even good news could not stop it. Intel reported sales up 25% and beat estimates by 11%, and the mood barely lifted. The question underneath all of it is simple and uncomfortable. What if this boom costs more than it returns? To be clear, none of this means the AI story is over. The revenue is real and still growing fast. But this week, the market started pricing a gap that had been easy to ignore. The distance between how much these companies are spending now and how much it will actually earn them later. Nowhere did that question bite harder than at Tesla. For years, the stock ran on a story about the future. Robotaxis, humanoid robots, artificial intelligence on wheels. Investors were happy to fund the dream and wait for it. This week, the waiting got expensive. Tesla reported earnings that missed, and buried in the results was a figure the company had not shown in 2 years. Negative cash flow. A business that had reliably thrown off cash was, for a quarter, burning it while it poured money into its own AI ambitions. The stock fell more than 14%, one of its worst days ever for market value. The paper's own framing was blunt. The market punished Musk, and it punished his fans. And this was the company that, more than any other, had trained investors to look past the numbers and buy the vision. When even Tesla's believers flinched, it said something about the mood of the whole market. It is the same lesson as the rest of the week, just in sharper focus. A story about tomorrow only holds while the cash from today keeps flowing. When both weaken at once, the market stops paying for the story. That is the froth signal worth watching. Not that spending on AI is wrong, but that investors have quietly stopped taking it on faith. While tech was unraveling, a second shock arrived from a completely different direction. Oil, quiet for months, came roaring back. The trigger was geopolitics. As the president warned that Iran could soon face major military punishment, and with the war there still live, traders priced in the risk to supply. Brent crude, the global benchmark, topped $100 a barrel for the first time since May. The U.S. price jumped more than 6% in a single day to just over $92, up from the low 80s to start the week. And oil never stays in the oil market. It leaks into everything. You could watch it spread in real time. Higher energy prices stoked fears of a fresh inflation wave, which pushed bond yields up, which pushed mortgage rates to their highest in nearly a year. The 30-year fixed hit 6.58%, and some economists now warn a near 7% rate is coming. Inflation had been cooling in June, partly because energy was cheap. This week, that gift got taken back. For an ordinary household, this is where the abstract becomes concrete. A more expensive barrel of oil eventually shows up at the gas pump, in shipping costs, in the price of almost everything that has to be moved. And a higher mortgage rate quietly prices some would-be buyers out of a home. This is how a headline about a distant conflict becomes a number on your monthly budget. There is a political layer, too. Cheap gasoline was one thing Republicans were counting on heading into the midterms, and $100 oil complicates that. For investors, the takeaway is plain. The inflation fight is not finished. It just found a new front. For all the anxiety, the deal machine barely paused. If anything, it got louder. When money gets nervous about growth, it stops chasing stories and goes shopping for control instead. The saga of the week was Paramount's $81 billion move to buy Warner Bros. Discovery. On Tuesday, a federal judge slapped a temporary restraining order on it and froze the deal. By later in the week, European regulators had approved it after the companies offered concessions. One media empire, two very different verdicts, still very much in motion. Elsewhere, the shopping list ran long. Nestlé agreed to sell half of its water business, the home of Perrier and San Pellegrino, to a private equity group for about $3.5 billion. Utz, the snack maker, agreed to go private in a roughly $3 billion deal. Econ sold off Pep Boys. Stripe was in talks to buy an AI startup. There was a defense and industrial thread running through the week, too. Northrop Grumman and Lockheed Martin both raised their outlooks on the back of steady military spending, and Airbus shares jumped after it promised to lift profitability. When investors are nervous, the businesses tied to government budgets and hard assets tend to look a little safer. Notice the pattern. Some of this is AI ambition, like Stripe reaching for new tools, but a lot of it is the opposite. Mature, unglamorous, cash-generating businesses being bought up and taken private, away from the glare of the public market. That is the quiet counter story to the tech sell-off. While the market was falling out of love with expensive promises, private buyers were quietly loading up on things that simply make money today. The last thread runs through Washington and Brussels, where the rules under the market kept shifting. There was a softer signal in the economic data as well. An index of leading indicators slipped as consumer spending cooled, a reminder that beneath the AI headlines, the everyday economy was losing a step even before oil jumped. The administration is preparing a new legal foundation for its tariffs after a court ruling knocked out the old one. In plain terms, the trade uncertainty that has hung over markets all year is being extended, not resolved. Companies trying to plan around tariffs still cannot. Across the Atlantic, the European Union fined Google $1 billion for breaking its digital competition rules. a penalty that risks inflaming tensions with an administration already primed for a fight over how Europe treats American tech. And a quieter one worth watching. The SEC is moving ahead with a plan to make quarterly earnings reports optional, even after a flood of public comments came in overwhelmingly against it. If it happens, the steady rhythm of information investors rely on, 4 report cards a year, could start to thin out. None of these moves a stock tomorrow, but they are the plumbing. Tariffs shape costs, fines shape how the biggest companies behave, and disclosure rules shape what you get to see at all. So that is the week. A market that stopped taking the AI boom on faith, an oil shock that reopened the inflation question, and a deal wave chasing cash in hand while everyone else chased the future. And again, none of this is financial advice, just the context to read the days ahead. Here is what I am watching next week. Whether the rest of the Magnificent Seven, as they report, show the same cash flow strain that Alphabet and Tesla just did, and whether oil holds above $100, because if it does, the inflation story starts writing itself. If this helped the week make sense, subscribe. A new weekly brief lands every weekend, and there is a Market Minute most trading days. This has been Market Minute.